Sounds pretty bad, right? Wow, 1.2 billion. They are losing more money than they were losing a year ago. This is fake news. It's all fake news.
The operating business is doing better than it was a year ago.
It's an accounting thing. I give stock-based compensation. This is not a cash loss. Uber announced earnings end of day yesterday. And of course, you know what that means. The haters are out and they're coming after Uber. Lyft had earnings 2 weeks ago, maybe 10 days ago, and they announced that they were accelerating their path to profitability. They had, I think, set an expectation of 2021. They said, we think we could do this by the end of 2020. Uber beat on having less losses than was expected and what they had given guidance on. They actually increased their revenue and growth outlook beyond what had been previously reported. They beat on revenue. All around, it was a very good earnings report. We're going to dig into it. But first, let's look at what the news has reported about this. So this was the thing that popped up for me on LinkedIn. Chief Executive Dara has outlined Uber's road to becoming profitable, which will happen in 2021. Its revenue increased 30% to $3.8 billion for the quarter, while its losses widened to $1.2 billion, compared with $986 million this time last year. Sounds pretty bad, right? Wow, $1.2 billion. They are losing more money than they were losing a year ago. Wow, Uber's not in a good place. Uber lost $1.1 billion. Uber stock falls, but quarterly loss topped $1 billion. This is fake news. It's all fake news. Where did this $1.2 billion number come from? It came from the fact that they give stock to their employees, and now the employees can sell that stock. You know, they give options to employees, and you have to register. I think they have like a $400 or $500 million charge on this quarter as that being a cost.
Right, and they had a much bigger charge on the prior quarter, so the loss was like several $1 billion, and that, of course, got headlines. But it was really this share charge that was even bigger that made a difference. What did Uber actually lose in Q3? $585 million. And the quarter before that, $656 million. Relatively, that's like literally half the number that is being reported and in all the headlines. And, they're losing more money than a year ago. It's just false. I mean, there's no other way around this. This is just false advertising. The operating business is doing better than it was a year ago. It's an accounting thing. I give stock-based compensation. This is not a cash loss, right? This is purely an operating business lost $585 million, which is the number long-term that if you're an investor, you should be keeping an eye on. Can the operating business become profitable? And it looks like it's trending in the right direction. Right,
but all of these news reporters, it's fake. You know, they're just trying to grab the headline, throw Uber in the dirt, and the business sucks, like they've lost more money than a year ago. I mean, it's patently false information. I mean, this is just a technicality that they want to use for the headline for the article. So more good news from Uber's earnings results. So let's look at these numbers, by the way. Lyft does not give you these numbers, okay? Just Uber does. Here is their gross bookings. Quarter over quarter, you can see here, now it's about $16.5 billion. This is GMV compared to $15.75 billion the prior quarter. How did they get this growth? They actually very nicely break all of this out for you, the investor, to make your own determination on how well they're doing. And they had 3% quarterly growth in the ride-sharing business, and they had 8% quarterly growth in the Uber Eats business. And not only now they're breaking out for you here the EBITDA by group. The one thing to keep in mind, though, that they're saying, hey, Rides has positive EBITDA of $500 million. If you look down here, corporate G&A and platform R&D, it's basically just a basket of general R&D spend, $622 million. That they're not,
I think this slide's a little skewed, okay? But they are providing much more transparency than Lyft is. Look at Uber Eats. Without even including the $622 million line item, they're basically, if you just annualize that out, that means they're basically investing $1 billion a year covering losses in Uber Eats. Uber Freight, that number's $200 million. These are significant investments that they're making. Gross bookings, right? This is how you can calculate that 3% growth rate on rides. This is how you can calculate the 8% quarterly growth rate on Uber Eats. And so what Lyft also beat, but how did Lyft beat? Lyft beat on revenue growth. Uber did the same thing. Look, they show you here, this line, that top line in this middle graph here. So 21.6 in Q2, 22.8 in this most recent quarter. That's their take rate. So for every $100, Uber is taking $22.80. They increased the take rate by 1.2%. What does that do? Oh, it allows them to get this 11% bottom right here, quarterly growth, revenue growth metric, right? Because if you actually just look at the GMV, Uber Rides is growing at 3% quarterly. Eats is growing 8% quarterly. You can't just add 3 and 8. Okay. So what is the other missing variable? It's take rate. And that is what Lyft has prevented investors from really understanding. What is the growth of the total throughput versus the growth of the take rate? And as you can see, that competition is becoming a little less fierce between Uber and Lyft. We're seeing, and both platforms in both of their earnings have attested to the same thing now, the past 2 earnings announcements in a row, which means that they have a little bit more flexibility to increase the take rate.
You've seen both of them focusing more on revenue growth rather than basically market share growth. The telling thing, as we've discussed previously, is that Lyft no longer discloses gross bookings. So you can't really do an apples to apples comparison of basically the size of their throughput, the GMV for the rideshare business. All you really have is the revenue number. And what that typically means is they're increasing revenue, but they're not growing the overall size of the throughput very well.
So $3.65 billion in GMV for Uber Eats. Year over year quarterly growth, 77%. I mean, 8% quarterly growth on this, on almost $3.5 billion. That's pretty serious growth. What this is saying is, if you just remember last week, we had Grubhub come out with a pretty devastating response. Their stock price was more than halved as a result of that.
They basically said, we need to double the number of restaurants on our platform and we need to seriously invest in growth. So earnings will be down is basically what they said, because we have competitors like Uber Eats and DoorDash.
But what's interesting is you still see Uber increasing take rate on Uber Eats, and they still have strong growth. It's a massive business. I mean, annually, this is a $12 to $15 billion GMV total throughput business. And they have over $10 billion in cash. So when you really want to, let's say doomsday scenario, Uber has like 3 years of runway. And
I think they have like 9-point-something billion in cash still on the balance sheet, and I'm sure they could go raise more in debt or equity if they needed to. So the business is in a good position.
No, they said 12.7 billion.
12 point, okay.
So they're good. They raised $1 billion earlier this year in ATG, which is their autonomous business unit, which received $1 billion from Toyota, SoftBank, and one other firm. I'm still bullish. I mean, this I think just confirms. Now the irony is that their stock is down 7% today. More so if you include from yesterday to after hours. I think in general, just the sentiment on Wall Street is negative towards these businesses that are losing a lot of money.
and still have very high valuations.
They're still in the shadow of WeWork on this one.
Exactly.
Even though it's a very different business.
Very different business. And I don't think they're getting a fair shake. Probably Lyft for a similar point to a similar degree, but I think Uber to more so, just given the strength and platform conglomerate status that they have. Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.